I'm going to be honest with you guys. I'm a little bit worried about the stock market right now. And yes, my Schwab account's pretty much at all time highs. My 2 year return is 165%. But I hate to be the bearer of bad news, but there are some critical things happening in the stock market right now that we have to talk about. So I'm going to show you a series of a couple different charts, and I'm going to outline a whole thesis in this whole video right here of why the stock market might be in trouble, what you could do to capitalize, and honestly, you kind of got to do it right now if it's going to work out because the stock market is potentially going to go down quite a bit. So we have to talk about it. Stick around for the whole video. You're going to get a lot of value from this. Let's dive in. So there's some extremely important things that we do have to cover with this chart because, I don't think a lot of people really believe that the stock market could actually go down. I mean, look at Palantir, look at SoFi, look at all these stocks that pretty much have been going straight up. People are so conditioned that if you are an AI company or you do anything affiliated with AI, that implies that the stock pretty much has to go straight up. And that is a complete opposite. And, good investors understand that. But most people that are investing on X or YouTube or, Instagram, TikTok, whatever it may be, they just look at a stock. They see their friends buying it. They see their work colleagues buying it. They see people on X buying it and making money and YOLOing call options or whatever it is. They see people making money. But what they don't realize is that there's something brewing in the stock market right now, in my opinion, that is going to be potentially bad for the market and you could potentially lose a lot of money. I'm not trying to scare you. I'm not trying to get you to watch this whole video, whatever it may be. And I'm also not trying to get you to think that, oh my God, Brandon's this big bad bear. He hates the stock market. He bought his puts. He sold everything. He is short the market. That is the complete opposite. I am 100% long the market. I have no bearish plays in my portfolio. I'm just saying that right now, there's certain things happening, and I'm just kind of like trying to pound the table with this with you guys because it's like everybody's a genius in a bull market. There's so many people that made a lot of money, and I'm making a lot of money too, especially off this April dip that we had with tariffs. But when things turn sour, and it doesn't really have to be for some specific reason, it could just be because simply the market's not hot anymore, and then we get like downward momentum in the stock market. That could trigger a massive panic sell off because the vast majority of trading right now is pretty much all algorithmic, meaning if a stop loss level gets hit, that one hits, the market sells, another one gets hit. And it's just kind of like this chain reaction of orders going in where they're selling their stocks. So, okay, let's take into the chart here. So, 1 year return, 10 year returns. The green vertical line right here corresponds to the current price earnings ratio level that the S&P 5 is trading at. So, if you don't believe me, we could go over here and look at the Yardeni chart. The red line right here corresponds, let me get myself out of the way. The red line right here corresponds to the S&P 500 price earnings ratio level, and this is updated as of August 18th. So right now we're roughly right around 23 for the S&P PE ratio, and if you want to guess where this green line's at right now, it's closer to 22. So actually this is a little bit more optimistic or a little bit more bullish than what the other chart's saying. It's just like, a little bit of discrepancy between the data. But the point is this, look at what typically happens in the stock market 1 year going forward when we're trading at a price earnings ratio of roughly 22 to 23. You're going to say, well, I don't really know. It looks so scattered, it's hard to really say. And you know what? You are 100% correct. It's randomized. On a 1 year basis, it is very, very hard to know what the stock market is going to do, what a stock is going to do, what really anything is going to do in the stock market. Because in the short term, the stock market's usually always irrational. It goes above or below what the earnings per share growth line is, but it doesn't have to always correlate to what the actual companies are doing. So 1 year is kind of just like guessing what you think the stock price should actually be. But if we flip back on a 10-year basis, do you see how much more organized these dots are based on what the price earnings ratio level is? So let's look at this chart here because honestly, it's really good to go and reference back and forth. Let's take a look at what happened in 2008 after the great financial crisis. What was the price earnings ratio level of the S&P sometime after that great financial crisis? We could say roughly 10ish. If we go back to the chart, what is a typical return of the stock market? So 11 is a PE right here. We'll just say 11 because, to be honest with you, it's pretty close to 11. What is a typical return going forward on a 10-year basis, annualized? So every single year, what is their average return expected to be if we're at a price earnings ratio of 11? Well, 10 is here, 20 is right here. We'll just say 17% is average what the stock market should do if we're trading at roughly an 11 price earnings ratio level. And if you look at the chart, the S&P pretty much went straight up off of that base rate there. The S&P 500 did return a similar rate of return to that. Now, what will typically happen in the stock market if we're trading at roughly a 14 price earnings ratio level? And I'm choosing 14 for a reason because if you look to the left, that is roughly a 10% rate of return. So 10% rate of return, a lot of them are clumped around the 14 price earnings ratio level. That is typically what the stock market will return, and that is what the price earnings ratio level is right here is 14. So if we go and find something for a PE ratio level of 14, so we'll just look at 15, like average of 15 through here, a little bit below, a little bit above, but on average through this whole time period, the average price earnings ratio level is roughly 15-ish for what the actual S&P 500 is trading at. So price earnings ratio level of 14 to 15, you could expect a 10% annualized rate of return. And it's no surprise that the S&P 500 in the last 50 years has averaged roughly 10% per year. Sometimes it's a little bit above, sometimes it's a little bit below. But there's a storm brewing right now, and everybody that thinks the stock market only goes up, which it does not. And again, I am not Mr. Brandon the Bear. I am Brandon the Bull usually, and I'm very bullish in the long term. But in the short term, we have problems, and let me explain this for you. So, P ratio again, 22 to 23. Look at what happens in the stock market, average annualized return for the next 10 years. Remember, this is per year. Do we see anything even over 5% that typically happens to the right of the chart? No. Look at what it actually is. It's often negative for the next 10 years. So that literally means that if you put in $100 into the stock market right now, in 10 years from right now, it is possible that you will have less than $100 in 10 years from right now. I know it sounds absolutely insane to talk like that, but the numbers do not lie. History does not lie. And of course, history is not a guarantee of what's going to happen in the past is going to happen in the future. But just look at this. Like, people don't understand when I say this, that the market valuation is a little bit more expensive than what you think. Yes, AI is great. Yes, we're getting massive productivity boosts. Yes, we're going to have robots. We're going to have self driving cars. But at the end of the day, how much of that is priced into the current valuation right now? Price is what you pay, value is what you get. How much of that is priced into the stock market right now? If you ask me, I'm going to say quite a bit. And I have this analogy, just roll with me on this because I think it's really going to help you out a lot. And let me just flip back to the chart right here. So, when the stock market came off of this base right here after the great financial crisis at a PE ratio of 10, what do we think that PE ratio is? Do we classify that as cheap or expensive? It's going to be cheap. On top of that, were the companies probably going to start their next, big wave of growth going forward? Yes. So when you go get on a plane, you get on your big jumbo airliner, your 777, your 737, whatever it is, usually you have two engines on that plane. So right here, you have the engine of earnings growth and you have the engine of you're trading at a low price earnings ratio level. And that price earnings ratio level of roughly 10 or 11 has room to expand and go up to like 23, which is what we're at right now. So there's two engines flying that plane through this whole period right here. But as the market got a little bit expensive up here, which is when we had inflation and the Fed had to raise interest rates, which then dropped the market a little bit right there. This is roughly like a 35% drop. We blew out an engine. We had one engine that got blown out and the stock market corrected down. This was the price earnings ratio actually contracting, meaning the market was getting cheaper in this time period. So it's kind of like we were flying on one engine, but we were just like barely flying on that engine and it kind of like blew out the other one that was flying too. So that's why the market went down. Price earnings ratio was a little bit high and it corrected down. And earnings per share went down a little bit too because interest rates went up that caused companies to make less money, blah, blah, blah. You get it. I don't want to go into that. That's for really a different video. But my point is this again. How much can the price earnings ratio level expand from the current 23 that we're at right now? Is it going to go from 23 to 30? Doubtful. If we look all the way to the left, since 1985, it has never crossed over 25 for the forward price earnings ratio level for the S&P 500. Never. And keep in mind, this right here where I keep pointing to, this was the dot-com crash where the market fell over 50%. I'm not trying to scare you and say, oh my God, the market's going to fall 50% right now. But what I am saying is that we're at a similar valuation level. It's possible. And if you look at to the right of this chart right here, what historically has been said about how the returns are going forward since 1988. You can see it's kind of blurry, but it's 1988. All these dots are plotted right here. The typical return is not really that good. So I've been preaching on YouTube, I've been preaching on X, I've been preaching on Discord, wherever it is, telling people, yes, I am bullish the market in the long term, but in the short term, expect volatility. Don't over leverage yourself. Don't get all out of control with stock options and YOLO calls just because stocks are going up. Understand that price is what you pay and value is what you get. And if you overpay for a good company, that is a bad investment. You want to underpay for a good company. All right, now hopping into my account, I could show you a couple things that I'm doing in there super quick. So current value is $992,000. It's over a million. Like I said, when my son got born, he's 6 months old right now. I sent him a good chunk of shares out of this account, and I didn't go sell the shares to like generate cash and then send him cash. I just transferred shares from my account to his account. So super quick, Triple Q, VOO, Tesla. You could kind of go and read through all this stuff. I do have a couple puts that I sold on TSM and some puts that I sold on UNH. Those are doing super good. This was kind of like a table pounder United Health. Like, we're up 16K right here, 14K right here, 4K right here. I mean, you could say 5K there. Another 4K on the shares. We got in before Warren Buffett did. I'm not saying like, oh my God, I got lucky because Warren Buffett bought. Like, I've been preaching on Discord on the Zoom calls. We don't need Warren Buffett to make money on United Health. Maybe it's going to be volatile. I'm sure it's going to be super volatile, actually. But let's talk in a year or two. Maybe I take profits right now. Maybe I don't. Who knows what I'm going to actually do? But all my stuff is posted live in Discord if you want to check it out. The link is below if you want to get in for free. But other than that, I hope you guys got value from this video. Please like and subscribe. It really helps out the channel a lot. And I'll see you guys in the next one.